Hello friends, welcome to Mock Test channel. Today in this video, we are going to be covering currency derivatives exam important question and answers. So friends, if you are looking for latest question and answers with explanation, please do visit our channel www.mocktestchannel.com. Therein you will find NISM Series 1, that is currency derivatives exam mock test, which covers all the latest question and answers with their proper explanations, which covers the numericals as well, which becomes a very important part for this exam. So let us start with the first question. Which of the following example is the market making? Options are: a real estate agent quoting a price to sell a bungalow. B. A jewelry store owner quoting a price to buy old jewelry and also quoting a price to sell new jewelry. 3. A wholesale fruit vendor quoting a price to sell fruits at low price. D. A steel junk dealer quoting a price to buy a very old car. So friends, the correct answer is a jewelry store owner quoting a price to buy old jewelry and also quoting a price to sell new jewelry. So whenever somebody is quoting both the buy and sell price, then we are saying that this is an example of market making. Okay. Going to the next question. With respect to trading time for world's major currencies in over-the-counter market, which of the following statement is true? Options are: the currencies are traded across time zones. B. Currencies are traded as per permitted time of the respective countries. C. None of the above. So friends, the correct answer is that the currencies are traded across the time zones. Okay, there is no specific time durations in which the trading is being held, just like in stocks, but here it is 24/7, that is across time zones the currencies are getting traded. Next, when a person buy a put option, it means that he is buying a right to buy underlying asset. State whether it is true or false. So friends, as you understand, the put option is buying the right not to buy but to sell. Okay, so the statement seems to be false over here. So the correct answer is false. Okay, so what is put and call? Put is when you are buying the right to sell something, and buy a call is when you are buying the rights to buy something. Okay. Next question. Mr. Singh executes the following currency future trades: buy USD INR and sells UUR for an equivalent amount. What view has Mr. Singh executed? So if you look at this question, what is he buying? He is buying USD INR and he is trying to sell UUR INR. So that basically means that he has an expectation that the USD is going to be coming down. Like if you look at the correct answer, that is EUR depreciating against USD. So he has a view that the European currency is going to be depreciating against the USD. That's why he is buying the USD and is selling the EUR currency. Next question. An Indian company has both imports and exports in GBP, that is Great Britain pounds, of an equal amount. However, the export realization comes a week after the payments are made for imports. Which type of currency risk is the company facing? The risk that the company is facing is the risk of INR appreciation, because if you look at it, the export realization is coming only after a week after the payment. So it can mean that later on when the payment arrives, the INR must have appreciated and he will get a lower value. Okay. Going to the next question. What is the simultaneous buying and selling of EUR INR future contracts across two different maturities called? So it's not only for EUR INR or currencies, but it is also very much a valid question for the shares as well. When you are buying out and selling out things at two different maturities, then that is called as spread trading. Okay, so simultaneous buying and selling of EUR INR futures contracts with two different maturities is called as spread trading. Going to the next question. Dash is true for exchange traded derivatives. What is true? That's the centralized trade settlements. When you are going for exchange traded derivative, you are sure that there's a centralized organization who will do the settlement for your trades. Okay, so you are opting for centralized trade settlements. What course of action can be followed by an investor if he or she is not satisfied with the decision by the arbitration tribunal? Whenever there is some dispute, there is an arbitration tribunal set up which takes the final call as to what should be done whenever there is some grievance. But What if the grievance settlement is not something that is satisfactory to the investor? What can he do next? The options are: nothing, as the tribunal decision is final. B, he or she can approach SEBI for suitable action. C, he or she can approach any court of law. D, he or she can appeal investor grievance cell of the relevant exchange. So, friends, the correct answer is that he can approach the court of law. Whenever the arbitration tribunal courts are not able to give you justice, you can directly approach to the court of law. Going to next, the default mode of settlement in over-the-counter spot market is: option as decided by the merchants, B, net settlement in cash, C, always delivery based, D, none of the above. So as you know, over-the-counter settlements are always delivery based. You have to pay it in cash. So it's always delivery based. What is the initial deposit that is required to initiate a currency future position called? Of course, whenever you are initiating a currency future, you need to pay in some initial margin amount. So what is it called? It's called initial margin only. Okay. So there are several options, that is called initial capital, portfolio margin, account opening margin. Don't get confused. It is called initial margin. Internationally, for the most of the currency pairs, the base currency is, internationally, as you all know, what is the base currency? Base currency is US dollars. Okay. Going for next, state true or false. Unlike option, future contract gives sellers both the rights and obligation. Say it whether true or false. The statement is true. Okay. In options, there is no obligation, but in the future contract, it gives seller both the rights as well as the obligation to carry out the deal. Which are the main basic accounting heads to be maintained by any market participant for maintaining currency future accounts? Options are: profit and loss currency futures. Option B, initial margin minus currency futures and mark to market minus currency futures. C, initial margins minus currency futures and mark to market minus currency futures. So the correct answer is option B, that is initial margin is to currency futures and mark to market is to currency futures. Next question, guidelines for accounting of currency future contracts are issued by who? Issues the guidelines for this? Is it RBI, ICWAI, ICAI or FXCA? The correct answer is ICAI, that is Indian Chartered Accountant Institute. Okay, ICAI is the one who issues those guidelines for the currency future contracts. At 11 a.m., the RBI announced the credit policy and a deduction in interest rates. Generally, such a step will lead to dash of rupees. Say, for example, RBI is now announcing a deduction in the interest rates. So, what will happen to the currency? The normal trend that is seen is that it will lead to weakening of the currency, or the weakening of the rupees will happen next. Going next, generally, who are the market makers in the OTC, that is over the counter market for currency options? Options are brokers, banks, exchanges, and agents. So usually the correct answer is banks. Going to the next question, of the following, what best describes the guidelines for brokers with respect to execution of client orders? Okay, what has been the best guideline for the brokers when it comes to executing the client order? Options are: intimate the execution or non-execution by the end of the day. B, intimate the execution or non-execution within 3 hours of the deal execution. C, promptly intimate the execution or non-execution of the order. D, intimate the execution or non-execution within 2 hours of the deal execution. The correct answer is promptly intimate. Whenever you have a execution which has happened, or if it has not happened, you promptly inform the client. That is the best thing that you can do. You don't have to wait for end of the day or 3 hours or 2 hours. Okay. Going to the next question, in case of currency options, the net option value is added for short options and it is deducted for long option to liquid net worth of clearing members. State whether it is true or false. So the answer is false. As you know, here the statement is written in opposite way. Like if you look, the net option value is added for short option and it's deducted for long option is given, whereas the correct answer is it is added for long option and it is deducted for the short options. Which of the following is true? Exchange rates are quoted in per unit of quotation currency. B. Quotation currency is the first currency in the currency pair. Base currency is the second currency in the currency pair. Base currency is the first currency in the currency pair. So of this you all should know that the base currency is always the first currency in the currency pair. Whenever I say USD INR, that basically means the base currency here is the USD. Okay, so that is how the naming goes or the nomenclature goes. At what time does JPI INR future contract stops trading on the contract expiry day? So if you see JPY INR, what is the base currency over here? JPY is the base currency. So question over here is, at what time does the future contract stops for trading on the contract expiry day? Options are 5 p.m., 3:30 p.m., 3:30 p.m. and 12:30 p.m. So the correct answer here is 12:30 p.m. Okay. So going to the next one, the lot size of EUR INR future contract is. Options are 10,000 EUR, 10,000 INR, 1000 INR and 1000 EUR. So the correct answer is 1000 EUR. Can we say that when USD INR falls one way, this means that there is a decrease in volatility? So it's asking, it's falling one way, does it mean that it will decrease the volatility? The correct answer is no, because you see, whenever you have something falling or something going up, it doesn't actually count how much it can fall, whereas volatility is all about how much, something falling, to which degree does it fall or rise is what volatility is all about. So we cannot say that the volatility is going to decrease or increase because something is falling or something is growing. To magnitude to which something is falling is growing is what is going to be a very good indicator of volatility. If it is falling by very large numbers, then we say that the volatility is high, whereas if it falls by a very small number, then we say that volatility is low. Next question, assuming everything else remaining same, any development resulting in widening current account deficit of India will result in. The options are strengthening of INR, B, weakening of INR, C, 15% of open interest or EURMN, whichever is higher, D, unattempted. So friends, the correct answer is, whenever you have a current account deficit widening, it usually results in weakening of the INR. What is the over the counter traded derivatives? So question is that what is true for the over the counter traded derivatives? Option is centralized risk management, B, centralized trade management, C, available only for stocks and currencies, D, no centralized limits on trading positions. So over the counter is something like which is not happening within the exchanges, something like you and your friend do a deal and exchange something, then that is over the counter traded. Okay, so when you and your friend are doing something, then it doesn't have to go through the rules of the exchanges, so there is no centralized limits when it comes to trading positions, there is no control basically. So that's why we advise to go for exchanges, because then you have somebody called as a clearing department, clearing agencies, which take participation in the centralized trading of the trades. Okay, so what is true for the over the counter? It is that is no centralized limits on trading position. One of the key difference in over the counter and exchange traded EUR INR currency option market is related to. Options are given: lot size, B, requirement of proof of underlying FX transaction, that is for an exchange transaction, C, market timing. So the correct answer is both B and C, that is requirement of proof of underlying foreign exchange transaction and market timing. Both of them is the key difference when it comes to over the counter and exchange trader. Lot size can be same, whether you're trading an over the counter or exchange trader, you can decide to have the same lot size. Okay, doesn't matter. Going to the next, with respect to the settlement of over the counter forward contract, which of the following is true? It is always delivery based. B, the market participant can decide to settle it via gross settlement mechanism or net settlement mechanism. C, it is exchanging the difference in value of currency. D, none of the above. So friends, of course, like you already know that over the counter is always delivery based. Okay, so over the contract is always delivery based. If until this point, if you have liked whatever has been taught, please hit on that like button it's a huge encouragement for all of us. Let's go for the next question. Margins across various clients of a member are collected on gross basis. State whether true or false. The answer is correct, that it is collected on gross basis. Okay. Going to the next question. When a client defaults in making payment in respect of daily settlement, the contract is closed down. The amount not paid by the client is adjusted against what? Option are bank fixed deposits of the client, PPF balance of the client, initial margin paid by the client, shares deposited by the client or the trading member. So the correct answer is initial margin paid by the client. So if the contract is closed out and there is still some amount that is pending, then that amount is adjusted against the initial margin that is paid by the client. Going to the next question. What is the order called which is not executed during the day? The system cancels the order automatically at the end of the day. So there are times when you place an order and it doesn't get executed throughout the day, and then the market is closing. So what are those orders called? So options are immediate or cancel order, stop loss order, good till cancelled order, day order. So the friends, the correct answer is called as day order, because it lasts till day till the market hours, and when the day is finished, then the order just gets cancelled automatically. The prices of a commodity in the spot market were volatile, due to which many traders were going bankrupt. In what way would the introduction of an organized future market help to spot the market of this commodity? So it's a very interesting question. They are saying that the spot market was very volatile, because there were so many traders and many of the traders were going bankrupt. So how does this organized future market is helping the commodity market is the question. Options are there will be increased volume in the spot price. B. The futures are introduced, it will shift the speculative activities to a controlled environment which will have good risk management systems. C. When futures are introduced, it will lead to new entrepreneurial activity. C. The risk will be transferred. So the correct answer here is option B. That is, when futures were introduced, it will shift the speculative activities to a controlled environment, which will have a very good risk management, because all of it is going to happen within the purview of the exchange with set guidelines. Okay, so there's a lot of risk minimization that happens when things happen within the exchange. Next, a person sells GBP INR and buys EUR INR for an equivalent amount. What view has he expressed? So what is he buying into? He is buying into EUR INR and he's selling into Great Britain pounds. So what basically he might be believing? He might be believing that EUR appreciation is going to be higher against the GBP. So that's the reason why he's selling something and buying something which is going to appreciate with time. Who acts as the central counterparty to JPY INR future trades in India? Options are the currency broker who executed the trade, B. the bank trading and clearing member, C. the exchange, D. the clearing corporation. So who is the central counterparty? It's the clearing corporation who is going to be acting as a central counterparty when it comes to future trades. Next question. A significantly better than expected consumer price index from UK will result in what type of movement of GBP against other countries? So it is a significantly better expected consumer price index which is reported for UK. So what will be happening to the GBP when you are comparing it with other countries? Options are GBP depreciating against other countries, B. GBP appreciating against other countries, then C. no significant change. So the correct answer is, of course, when you are expecting a better consumer price index, then you are also predicting that GBP is going to be appreciating when you are comparing it with other currencies. An expert currency future trader feels that INR should depreciate against USD in the next few months. What currency future trades would be profitable if he has the views comes correct? So basically what he is thinking, that the INR will depreciate against the USD. So what trade should he be doing? Basically he should go for the USD INR trade, because then he is buying the USD as compared to INR, and where he is expecting that the INR is going to be depreciating. Next question. Dash is the process of computing open position and determining mark to market margins. Options are clearing, B. settlement, C. pay-in, D. Payout. So friends, the correct answer is of course clearing. Clearing is what the process where the computing happens, where open position, and it is helping in determining the mark to market margins. The US government declares significantly lower retail sales data. This will result in USD dash against other currency. So they have declared a relatively lower retail sales data. So what will happen to USD? Of course, the USD will depreciate, right? Because when you have a very high retail sales data, then it was implying that the USD is going to appreciate. But this time it is declared that the retail sales data is lower than what they were expecting, so it is going to depreciate. An immediate or cancel order dash. Options are gets exercised on the last day. B is valid for 1 hour after it is entered in the trading system. C is either executed or cancelled as soon as it is entered in the trading system. D gets executed at the best price during the day. So friends, as you already know, the name is also very clear. It says immediate or cancel. So it basically means either it is getting executed right when it is entering the trading system, or it gets cancelled. So option B is correct. Option C is correct. It is either executed or cancelled as soon as it is entered in the trading system. What is done when a client defaults in making the mark to market margin payments? So there is a client who is not making this mark to market margin payments. So what will happen? Option are the matter is reported to the client banker and the amount is recovered from his banks. B, the client is allowed a maximum of 5 more trades so that he can make profits and pay the margin. C, the amount unpaid mark to market is recovered from his initial margin. C, the SEBI handles the matter as per guidelines. So friends, the correct answer, as you already know, that they have got his initial margin. So if there is an amount unpaid in the mark to market margin, he can get it recovered from the initial margin that this person has put in. The contract size of USD INR future contract is, options are USD 100, INR 100, INR 1000, USD 1000. So the correct answer is USD 1000. The Reserve Bank of India has permitted all the banks to run foreign currency INR option book so that they can offer currency options to their clients. State whether it is true or false. Options are true and false, of course. The correct answer is true. The RBI has given such a permission to run the foreign currency INR option to books so that they can offer these options to the clients. The initial margin shall be deducted from liquid net worth of the clearing member. At what time? At 10 a.m. in the morning, on online real-time basis, every 2.5 hours, every 1 hour. So the correct answer is on an online real-time basis is when these deductions are happening. And decrease in expected volatility increases the option premium. Options are true and false. So friends, you have to understand this question very clearly. They are saying there is a decrease in the expected volatility. What will happen to premium? Premium is the amount that you are giving so as to reduce the risk that you are taking. When is it more risky? When the market is volatile or when it is less volatile? Definitely it is more risky when the market is volatile. So here they are saying that the volatility is decreasing. So should it increase the option premium? No, it should rather decrease the premium because market is not behaving abnormally. It's not going with a very high volatility. So the statement over here is false. A decrease in expected volatility should in fact decrease the option premium that you are paying. A big potato farmer gets into a contract with a leading fast food restaurant to supply 10 tons of potato every month for a certain price. What type of contract it is? So this is a straightforward question. This is a forward type of contract wherein a potato farmer is getting in a contract with a fast food exchange to supply the 10 tons every month at a certain price. Okay, so that is an example of forward contract. Simultaneous buying and selling of USD INR futures across two different maturities is called. This is a similar question that we had, but only the currency was different. So what's the correct answer? Yes, you got it right. It's called spread trading. So when you are buying or selling something across two different maturities, it is called as spread trading. Which term best describes the UR currency? whether it is a free floating, managed float, pegged to gold, or pegged to USG. The correct answer is it is free floating currency. A trader is long in USG INR but option of strike price 82. The current spot price of USD INR is 82. What is the moneyness of this option? So you have to tell if it is in the money, out of the money, or none of the above, or all the money, at the money. So the correct answer is it's at the money. If you see the current price, spot price as well as the strike price is 82, then you are at the money. If more than one contract in a series are outstanding at the time of expiry or squaring off, the contract of the squared off is determined using dash method for calculating profit loss on squaring up. So options are first in first out, B last in first out, C as per the decision of the clearing corporation, C D the loss making contracts are first squared off. So friends, the correct answer here is first in first out. FIFO method is what is going to be used for calculating the profit or losses. What would be the base price of the first day of the launch of a USD INR currency future contracts? Options are whatever is the first price which is entered by the trader, B theoretical price for the contract derived using the interest rate parity principle, C the daily settlement price, D the settlement price of over the counter. So the correct answer is theoretical price of the contract derived using the interest rate parity principle. With respect to currency options in India, which of the following is true? Options are only exchange traded currency options are American, whereas over the counter are European. B. The only over the counter currency options are American, while exchange traders are European. C. Both over the counter and exchange traded options are European in nature. D. Both over the counter and exchange traded options are American in nature. So, what is the correct answer? That both over the counter and exchange traded options are European nature. We don't have an American in nature contracts in India.